there's always a chance of an early assignment. And if the stock goes into the money and it's getting close, there's a chance that somebody could execute that assignment to you early. I mean, we know pretty much when that would happen based on how much time value is left in that trade. But that doesn't mean someone on the other end of that trade may decide to execute it early. Doesn't happen very often, but it does happen. So a lot of times you just have to be aware that if your trade is in the money or close to the in the money, there's a chance that you could wake up the next morning and get a nice email from the broker saying, just what, you've just been assigned 100 shares, 200 shares of this stock at your short put strike. And when you tie up, and a lot of times people will say, well, that's okay, I'll take the shares. I'm happy to take the shares and sell puts against it. And what that does is that will tie up a lot of your trading account. So if you have a $100,000 account and you've been assigned $50,000 worth of stock, well, now you have $50,000 less to be investing every week. The other 50, you're writing calls and hoping to dig out of the hole. And it may take a long time to break even. And I can attest to that. I have stocks that have taken a very long time to kind of get out and break even. So, and the other thing on put spreads is it doesn't work really good in bear markets. So if we go into a major correction or a major bear market, selling put spreads is probably not our, should not be our go-to strategy. And I've got some stuff that I want to show you later as to what we could do to kind of modify this strategy during bear markets. So, and then, anytime you open up your email or your Facebook account, you'll see somebody saying, like, this is the perfect, money printing strategy. And so the only thing I would say is there is no free money in the market. We have to work really hard to make money, and we're not always going to win. We closed a trade today for a loss, and that will happen. That's part of the trading. And it's just it's a decision to say, are we going to kind of just continue to struggle with this trade? Is it worth struggling for? Or do we take our loss and move on? And sometimes that's a tough decision. But sometimes you just have to call the trade. It just didn't work out for us, and we move on. So don't believe all the hype. And so here's kind of the difference between when people sell naked puts. They, you choose how far out of the money you want to sell. Most people that do this will trade either a certain delta, like they might trade the 15 delta, or they may say, I'm going to trade 1 standard deviation away or 2 standard deviations away. And you can sell them weeklies or monthlies. I prefer selling wider puts. I mean, that's kind of the way I feel more comfortable trading. And and generally what I will do on my wide puts is I will sell the short put based on the analysis, and then either sell a 10 or a 20 wide spread. And I'll when we go through the slides, then I'll flip over to the system and I'll show you kind of how that works in terms of buying power reduction. But so, some people trade naked puts, or you could trade it as a spread, and there's no right or wrong answer. So whatever you're most comfortable with. Now, if you're in a qualified account like an IRA or a Roth IRA, If you do a naked put, they're going to take the full downside risk out of your buying power reduction. So if it's in a non-qualified account, like a regular trading account, that's when you can use margin and it will show your buying power reduction. But if it's in an IRA account, it's going to take the whole amount and set it aside as for potential risk. So the return on a cash secured put is way less than a spread in terms of return on risk.